Hello everyone. Today I'll be presenting on the development of a risk management framework for Tesla. As a global leader in electric vehicles and clean energy, Tesla operates in a highly dynamic and complex environment, from supply chain disruptions to cybersecurity threats and regulatory pressures. The company faces a wide range of risks that could impact its operations and growth. In this presentation, I'll walk you through how a structured, proactive risk management approach aligned with international standards like ISO 31000 can help Tesla identify, assess, and respond effectively to these challenges while supporting long-term sustainability and innovation. In this presentation, I'll share the risk management framework I developed specifically for Tesla. I'll start by introducing risk management concepts and why Tesla needs a robust system. Then I will explain how I applied ISO 31000 principles and stress testing scenarios tailored to Tesla's operations. Next, I walk you through how I identified and analyzed Tesla's operational risks, including interest rates and liquidity risk, and how I used models like the maturity gap and expected credit loss to manage financial exposure. I'll also present Tesla's risk assessment matrix, corporate risk register, and monitoring dashboards to provide real-time insights. I'll discuss the business continuity and disaster recovery plans I developed to ensure Tesla's resilience, plus the environmental, IT security, and financial risk controls I implemented. Finally, I'll cover strategic risks such as geopolitical, legal, and reputation challenges and how Tesla communicates its risk strategy. I'll conclude with my recommendations to strengthen Tesla's risk management going forward. So let's start by a small introduction to risk management. Risk management is the structured process of identifying, assessing, and responding to those risks. For Tesla, this is essential because it operates in a fast changing and highly competitive industry. A strong risk framework helps Tesla make smart decisions in all areas, from research and development to supply chain operations. For example, when Tesla considers entering a new market like India, it must evaluate political, legal, and financial risks before investing. Risk management also reduces potential financial losses from cyber attacks and supply chain issues, which have recently impacted the auto industry. It prepares Tesla for unexpected changes, such as reduced EV demand after subsidy cuts in China. Being proactive, like securing rare earth minerals or adjusting supply contracts, is more effective than reacting late. Tesla's framework aligns with ISO 31000, a global standard that ensures a consistent and reliable approach. However, because Tesla is innovation driven and operates globally, its risk strategy must also be flexible and tailored to unique challenges. In short, a strong risk management system helps Tesla scale globally while staying resilient in uncertain times. Why Tesla needs risk management? Because it faces risks from rapid innovation, changing regulations, and global instability in the EV industry. Also, because emission law changes require frequent vehicle updates to avoid penalties. Supply chain risks arise from reliance on raw materials like lithium and cobalt from politically unstable regions. Heavy research and development investments creates financial risks, including project delays. Also because global operations bring complex regulatory challenges and reputation risks from recalls and controversies impact stock value. This is why a strong risk management framework is essential for Tesla to handle these challenges effectively. Moving on to the ISO 31000 risk management principle. ISO 31000 is a global standard for managing risk at all levels of an organization. It promotes embedding risk thinking into both strategic plans and daily operations. For Tesla, this means addressing risks early, like identifying cybersecurity issues in autopilot during design, not after launch. It also emphasizes leadership involvement. Tesla's top management, including Elon Musk, must actively communicate risks. For example, public updates on delays. Also, transparency and ethical practices are expected by stakeholders, including investors, customers, and regulators. The standard clearly encourages continuous improvement, like using feedback from full self-driving FSD beta failures to refine systems. ISO 131,000 turns risk management into a living, adaptable system supporting Tesla's fast-paced innovation and long-term resilience. Stress testing scenarios at Tesla. Stress testing helps Tesla assess how extreme but realistic scenarios could impact operations. Geopolitical risk. Simulate chip export disruptions from Taiwan or South Korea and their effect on gigafactory production. Raw material price shock. Test the impact of a 40% lithium price spike on EV costs and Tesla's profitability. Regulatory scenarios. Explore delays and cost increases from European Union emission laws or software privacy regulations. Product recall simulations. Model sudden autopilot malfunctions to assess financial loss, stock impact, and customer trust damage. Cyber attack preparedness. Run simulations on Gigafactory systems to test response speed, backup effectiveness, and recovery plans. These tests help Tesla design mitigation strategies, protect capital, and boost operational resilience and investor confidence. Developing Tesla's risk management framework starts with understanding internal risks like manufacturing issues and data breaches, alongside external risks such as geopolitical tensions, interest rate changes, and environmental regulations. Following ISO 31000, risk management must be integrated across all departments to ensure clear communication. For example, sharing Gigafactory risk insights with finance and supply chain teams. Tesla identifies key risks like cyber attacks, lithium shortages, and regulatory shifts, applying controls such as supplier diversification and enhanced cybersecurity to reduce impact and likelihood. Continuous monitoring through KPIs and dashboards allows Tesla to adjust strategies in real time within the fast changing EV industry. The framework's flexibility enables Tesla to respond quickly to unexpected disruptions like pandemics or trade embargoes, supporting a proactive and sustainable risk culture. Operational risk identification. Operational risks at Tesla arise from internal process failures, human error, or system breakdowns. As a high tech manufacturer, Tesla faces risks such as robot malfunctions at the Fremont factory disrupting Model Y production, labor strikes at the Berlin Gigafactory delaying deliveries, and supply chain vulnerabilities from delayed lithium or cobalt shipments. Defective parts from suppliers can lead to recalls and legal issues, while inventory errors may impact customer satisfaction. Identifying these risks requires collaboration across engineering, procurement, logistics, and HR. Tesla should implement internal reporting and early warning systems like incident logs and supplier audits to promptly detect issues. This proactive approach aligns with ISO 31000, supporting effective risk evaluation and mitigation for business continuity. Operational risk evaluation and analysis. After identifying operational risks, Tesla evaluates them using structured tools like heat maps that plot likelihood against impact to prioritize risks. For example, supplier delays may be high likelihood, medium impact, while a robot failure during final assembly could be low likelihood, high impact. Root cause analysis helps address recurring problems such as tracing software defects to vendor code or integration errors. Tesla also applies Six Sigma methods like the mic to improve processes, reducing defects in areas like the paint shop. Financial analysis weighs mitigation costs, such as robotics redundancies or backup suppliers, against potential downtime losses. Action thresholds trigger contingency plans, for instance, activating alternate shifts if production falls below KPIs. This structured approach enables Tesla to to proactively manage operational risks, maintaining uptime, quality, and profitability. Moving on to the maturity gap model interest rate analysis. Tesla manages interest rate exposure using the maturity gap model, which compares the timing of interest sensitive assets and liabilities. For example, if Tesla holds $1 billion dollars in short-term variable rate debt but only $700 million dollars in short-term interest earning assets, the $300 million gap exposes it to rising interest costs. To reduce this risk, Tesla can shift borrowing to long-term fixed rate debt or issue bonds when rates are favorable. Modeling rate changes helps the Treasury assess impacts on cash flow and debt servicing. For instance, a 100 basis point hike could increase interest expenses by tens of millions annually. This approach supports informed borrowing, investment, and scenario planning, helping Tesla maintain financial stability amid market fluctuations and central bank tightening. Maturity ladder model liquidity risk. Liquidity risk concerns Tesla's ability to meet short term obligations without costly financing. The maturity ladder model helps manage this by aligning debt repayments with expected cash inflows. For example, if $500 million dollars in liabilities are due within 30 days, but only $300 million dollars in vehicle sales inflows are expected, Tesla faces a $200 million shortfall. To address this, Tesla can use revolving credit or delay non-essential spending. During slow sales periods, it assesses liquidity cautions like cash reserves and marketable securities. The latter model also highlights upcoming refinancing needs, allowing Tesla to issue green bonds or other instruments proactively. Automated cash flow dashboards enhance real-time monitoring, improving financial agility. This model is vital to Tesla's risk framework, ensuring operational resilience and investor confidence. Then we have the expected credit loss model. Tesla Finance faces credit risk from customer loans managed using expected credit loss model ECL under IFRS 9. Customers are segmented by risk prime borrowers with low default rates 1% and subprime with high rates 8%. Tesla estimates probability of default PD, loss given default LGD, and exposure at default EAD using historical data. For example, if a subprime customer defaults on a $60,000 loan and Tesla recovers $45,000 from the vehicle sales, the $15,000 loss is the LGD. Multiplying PD by LGD by EAD calculates the ECL, informing loan loss provisions and financial reporting. This model also guides credit approvals and pricing adjustments, helping Tesla reduce exposure during downturns and maintain regulatory compliance. Moving on to Tesla Risk Assessment Matrix. This risk assessment matrix provides a clear visual overview of Tesla's key operational and financial risks, effectively prioritizing them by likelihood and impact. Highlighting cybersecurity breaches as a top risk makes sense given Tesla's reliance on connected technologies and data. The emphasis on lithium price volatility underscores how critical raw material costs are to Tesla's battery production and profitability. Legal liabilities around Autopilot reflect real world concerns about regulatory scrutiny and litigation risks. Notably, the matrix appropriately flags supply chain disruptions as high impact despite lower profitability, illustrating Tesla's vulnerability to geopolitical and material sourcing challenges. Medium risks like reputation damage and foreign exchange fluctuations acknowledge Tesla's global presence and public profile, while low risk interest rate exposure reflects strong financial positioning. Overall, this matrix is an effective tool for guiding Tesla's risk mitigation focus and resource allocation. Moving on to corporate level risk register, Tesla's corporate risk register centralizes enterprise risks with details on nature, owners, mitigation, and status. The main goals of corporate risk level register is to cover risks like cybersecurity, autonomous driving, legal issues, and raw material price volatility. Tracks impacts such as raw material cost changes affecting prices and margins. It also assigns risk ownership to departments, for example, IT for data breaches and procurement for sourcing. Includes mitigation strategies like long-term contracts and cybersecurity investments, and aligns with Tesla's business continuity and sustainability goals, and it is reviewed quarterly by the risk committee to reflect the change in risks and ensuring active risk management and ISO 31000 compliance. Risk monitoring dashboards. Risk monitoring dashboards give Tesla's leadership real-time visibility into risk indicators across departments. Display key metrics like factory outage probabilities, shipping delays, and EV delivery shortfalls. For example, flags delayed shipments if a supplier plant in China halts production due to lockdowns. Use visual tools like heat maps and bar charts for easier data interpretations and faster decisions. Accessible across the company to support coordinated responses from engineering, finance, logistics, and other departments. Mobile alerts trigger for emerging threats such as raw material price spikes or political instability. Dashboards fit into executive risk committee meetings and align with quarterly risk register updates, and it is enhancing Tesla's agility and ability to respond to risks in real time within the risk management. Business continuity and disaster recovery. Tesla's BCDR plan enables quick recovery during disruptions. It includes fire drills, offsite data backups, and supply chain contingencies. Maintains backup production sites for disaster risks. Sets recovery targets for critical systems, for example, it restores data vehicle ordering platform within hours after cyber attacks, and it follows ISO 22301 resilience standards and used alternative sourcing and digital tools during COVID-19, conducts regular drills and reviews to improve recovery. Environmental risk analysis. The environmental risks affect Tesla's operations and brand image. The key concerns are the battery recycling regulations, extreme weather impacts, and ESG compliance. Stricter EU lithium battery recycling rules may raise costs without innovations. Climate events like wildfires can delay deliveries and damage facilities. ESG performance impacts investor confidence and reputation. Tesla uses real-time environmental monitoring and annual sustainability reports. Mitigation includes green logistic partnerships and low-emission material sourcing. For example, Tesla collaborates with North American suppliers to reduce cobalt transportation emissions. And the last point is that controls ensure compliance and support Tesla's sustainability innovation mission. For the IT security risk management, Tesla faces significant IT security risks, especially around autopilot software and manufacturing automation. IP theft is a major concern, particularly in regions with weaker patent laws like China. For example, a leakage or reverse engineering of autopilot code could damage Tesla's competitive edge. Tesla encrypts data, enforces strict access controls, and conducts monthly penetration tests. Also, the staff receive regular training on phishing and ransomware threats. Incident response protocols ensure quick detection and containment of breaches. For example, automated patch deployment follows secure procedures after app breaches, and it also adheres to NIST and ISO 27001 standards for IT security and compliance. Derivatives for financial risk. Derivatives are key to Tesla's financial risk management strategy. It uses long-term futures or forwards to hedge lithium price volatility, ensuring cost predictability. It employs interest rate swaps to fix payments on variable rate debt from factory expansions. It uses currency forwards or options to hedge foreign exchange risk in international markets. Tesla purchases carbon credits with options to comply with environmental regulations and manage costs, and all the hedging activities are carefully tracked for regulatory compliance under standards like IFRS 9. Black Swan and Grey Rhino theories. Tesla's risk management addresses both Black Swan and Grey Rhino events. Black swans are rare and unpredictable, like a sudden global ban on autonomous vehicles that could disrupt Tesla's core business. Grey rhino are likely visible risks, such as a prolonged slowdown in EV demand due to market saturation or economic downturn. To manage these risks, Tesla maintains strong liquidity reserves for financial flexibility and pursues geographic diversification by expanding into markets like India and Southeast Asia, reducing regional dependency. Regular scenario planning with leadership helps identify vulnerabilities and develop response strategies, such as shifting marketing or diversifying products to maintain continuity. This approach helps Tesla prepare for both unexpected shocks and foreseeable threats, supporting long-term resilience and competitiveness. Sustainable risk management. Tesla's long-term ESG strategy supports sustainable risk management. It uses real-time sensor data to monitor emissions in manufacturing and logistics, enables proactive compliance with climate regulations, and reduces reputational risk. Raises capital through green bonds and ESG-linked loans to fund sustainability efforts, engages stakeholders via climate impact briefings with investors and regulators, board-level ESG committee reviews metrics like CO2 reduction and energy efficiency. Tesla integrates environmental, social, and governance factors into decision-making to help future-proof operations and maintain long-term investor confidence. Market risk management. Tesla faces significant market risks from changing consumer preferences and global economic trends. For example, shift from sedans to electric trucks could leave inventories unsold, thus reducing revenue. Falling oil prices may lower demand for EVs, especially in the US. New EV competitors may erode Tesla's market share. Tesla's stock price volatility can affect investor confidence and capital access. Mitigation strategy: diversify into energy storage, AI services, and autonomous software. Product diversification, for example, Cybertruck energy solutions, help balance demand shifts. Also, continuous market analysis and agile productions planning reduce exposure to market change. For the legal and regulatory risks, Tesla operates in a highly regulated global environment with evolving legal risks. Legal disputes over intellectual property, especially in autonomous driving, pose financial and operational risks. EV crash lawsuits may increase liability, particularly if tied to software faults. Global variations in labor laws and employment contracts create compliance challenges. Risk mitigation: establish an internal legal audit and compliance team whose responsibilities are to monitor regulatory changes, ensure legal compliance, and advise on emerging issues. For example, auditing AI software for privacy and discrimination laws reduces litigation risk. Terrorism, political and geopolitical risk. Tesla's global presence makes it exposed to terrorism and geopolitical risks. For example, the tensions between US and China may impact the Gigafactory Shanghai operations. EU sanctions on suppliers can delay parts and disrupt production schedules. Political unrest near facilities poses safety and shutdown risks. Tesla should monitor risks via alerts from agencies like OFAC and WTO. The mitigation strategy is to diversify supply chain and source from politically stable regions. For example, secure lithium from Australia instead of conflict-prone areas. Strategic partnerships and localized supply chains improve operational resilience. Reputation risk management. Tesla's brand value and customer trust are key intangible assets vulnerable to reputation risks. For example, a software glitch causing vehicle malfunctions can harm reputation. As a response, a swift public communication and over-the-air fixes to contain damage. Publishing ESG performance in quarterly reports shows transparency and accountability. AI tools can monitor real-time negative sentiment on social media. Strong media relations and regular press briefings support accurate public perception. Internal systems should track brand health via customer satisfaction, media tone, and social sentiment. Enables proactive and strategic reputation risk management. Technology risk and mitigation. Tesla's dependence on advanced technologies increases exposure to tech risks. For example, bugs in autopilot could cause fatal crashes and legal issues. FSD-AI biases may lead to discriminatory outcomes and regulatory non-compliance. As a mitigation, regular reviews of internal and external software vulnerabilities, rollback systems allow reversion of unstable software updates, monitoring competitor patent filings help identify infringement risk or innovation gaps. A cross-functional tech risk team ensures quick response and stronger preventive controls. Communication of risk strategy. Effective communication is key to embedding a strong risk culture at Tesla. CEO-led town hall updates highlight the importance of enterprise risk awareness. Company-wide training should cover cybersecurity, compliance, and continuity. Publishing the risk strategy in Tesla's ESG report promotes transparency. Real-time risk dashboard align perception and response across departments. Anonymous reporting channels encourage employees to report threats safely. Finally, conclusions and recommendations. Appoint a chief risk officer with tech and global operations expertise for executive oversight. Consolidate all risk dashboards into a centralized hub to enhance visibility and coordination. Use scenario planning to improve preparedness for market volatility. Integrate ESG factors into financial risk assessments amid rising inventory scrutiny. Expand stress testing to cover cyber attacks, supply chain issues, and regulatory shocks. Promote a risk-aware culture through leadership involvement and continuous employee training. Align risk planning with Tesla's innovation strategies for sustainability and resilience, and conduct annual reviews to update the framework with new threats, lessons learned, and standards. Thank you for your attention.